The next one we're going to be looking at is symmetrical triangle. It is formed when the slope of the prices highs and the slope of the prices lows converge together to a point where it looks like a triangle. And what this is telling us is that when you start having lower highs and then you start having higher lows to a point that shape starts forming a triangle in the market. So let me show you what it looks like in a real life scenario. This is a typical symmetric triangle. Can you see it? This is a typical symmetric triangle. You can see that we have been having lower highs, lower highs, lower highs, and then we've been having higher lows, higher lows, higher lows, higher lows. So in this case, you are looking for where the price will break out from, and then that's where you're going to be taking your trades. Do you understand? So if the price breaks upward, then you are going to be longing. But if the price breaks downward, you are going to be shorting. When you take a short trade, it means you'll make money if the market goes down. But when you take a long trade, it means when the market goes up, you'll make money. So that is what a symmetrical triangle looks like. So note, the price must break out of the triangle before you take a trade. Remember that the price must break out of the triangle before you take a trade, because when you see a symmetric triangle, you don't know where the price is going to break out from. So you have to be patient. That's why you have to be patient in the market before taking a trade. You want to see it break out to one side, if it's upside or downside, before taking a trade. So don't just pick a random side and take a trade. You wait for the triangle to break. Do you understand? Or you can keep taking short positions at each level around this place. You can keep taking a short position there, short position here, short position here, short position here, or you can keep taking long position here, long position here, long position here. But in this kind of scenario, I don't advise you do that. So wait till the price breaks out before you take a trade, because most of the profits will come from a breakout trade, which is in this scenario, the price broke to the upside, and then what happened to the price? Price spiked up. So this is a huge percentage on your trade. Let's check it out. So between that is about 27% upward movement. So that's a good trade. 28% in the market is a very, very good trade. That's what you'll be making in 2 years if you have to deposit your money in the bank. Do you understand? So the next one is a descending triangle. So a descending triangle is formed when one trend line connects a series of lower highs and the second horizontal trend line connects a series of lows. Remember, the lows are equal while the highs are lower highs. So when you see a descending triangle, oftentimes traders expect a descending triangle to break to the downside. So let me show you this in a real life scenario. So we said there's a trend line connecting lower highs of a chart. So this is the lower high, this is a lower high, this is a lower high, this is a lower high, and a particular trend line, horizontal trend line, connecting lows. You can see that the lows are not forming lower lows and they are not forming higher lows. So the lows are virtually equal, but the highs have been forming lower highs over a period of time. And in this kind of pattern, you expect the price to break to the downside. As you can see here, what happened to the price? Price broke below that triangle. So when you see a descending triangle, you'll be getting ready to take a short position. You know that price of that particular asset is going to drop pretty soon. Do you understand? So that is what a descending triangle looks like. The next one is ascending triangle. Ascending triangle is basically direct opposite of descending triangle. So instead of having lower highs, we start having higher lows. But if you can see the highs are the same. So this is one higher low, this is one higher low, this is one higher low. But as you can see, the resistance just represents highs hitting the same region. The high here hits the same region with this high, the high here hits the same region with this high. So when you see ascending triangle, you expect the price to break to the upside. Do you understand? So let's look for that in a real life scenario. So for a real life scenario, this area is the resistance. you can see the highs are not forming higher highs and they are not forming higher lows. They are basically hitting the same region. You can see they are basically hitting the same region. But for the lows, they have been forming higher lows, higher low, higher low. And in this kind of chart patterns, you expect the price to break upwards. And remember, I said whenever there is a breakout, 80% of the time, the price will always come down to retest that region that it broke out from before continue going up. So it's basically breakout retest strategy. Do you understand? So that's basically all for ascending triangle. The next one is broadening triangle. This one is difficult to see in the market, so I might not be showing a real life scenario. So when you see a broadening triangle, so it's just a formation that occurs during high volatility when a security shows greater movement with little direction. As you can see here, we can say price is not really going down and is not really going up, but there's a volatility in between the resistance and support. So this is the support and this is the resistance. So the upper trend line serves as resistance while the lower trend line serves as support. So you can keep buying at support, and keep selling at resistance until there's a breakout. So that's a broadening triangle. It is very rare to see in the market. So the next one is flags. So flags is basically a continuous pattern. So when you see a flag, it means that, so if you have been having an uptrend and you see a flag, most likely the uptrend will continue for a period of time. There's not going to be a reversal yet. So flag just signifies a consolidation in trend before continuing the prevailing trend. Do you understand? So once you have an uptrend, when you get a flag, especially if it's a bullish flag, then the trend will continue to go up 80% of the time. For example, in an uptrend, this is an uptrend, price has been moving up, and then you see a bullish flag. So a bullish flag looks like this. It's just like a down channel. So when you see a down channel in a bullish setup, bullish means uptrend. In a bullish setup, it means the price will most likely continue to go higher after a breakout. Do you understand? In a downtrend, when you see a flag is usually an up channel in a downtrend. So in a downtrend, a flag is usually an up channel. When you see them, most likely the prevailing trend, which is downtrend, will continue after a breakout. Do you understand? So let me show you in a real life scenario. We can see that there has been an uptrend for a while, and then there's a correction, and the correction is the flag here. You can see the price moving in between this down channel, and this is a bullish flag. So price moved in between this channel before breaking upward. This is what a bullish channel looks like. For a down channel, let's say you have been having a drop in price or a downtrend for a while, and then you start having this, a channel like this. Most likely 80% of the time, you find out that the price will go down for a downtrend. So this will be a bearish flag. So that's what it looks like in the market. So falling wedge is the next one we're going to be discussing, and they indicate a continuous pattern in an uptrend. And when you see them in a downtrend, they indicate reversal. So for example, let's say you've been having a downtrend for a while. A falling wedge usually look like this in a downtrend. So this is a downtrend, and when you see something like this, price moving in between this kind of shape, most likely the price will break up. Do you understand? So when you see falling wedge in a downtrend, most likely price will go up. So it serves as reversal pattern in a downtrend. But when you see it in an uptrend, it serves as a continuous pattern. So this is what it looks like in an uptrend. So in an uptrend, so let's say price has been going up for a while, and then you see a falling wedge. So around the side, you see a falling wedge to look like this. So when you see them in an uptrend, they signify what? Continuous pattern. If price has been going up and you see a falling wedge, most likely 80% of the time price will break to the upside and continue going up. But when you see them in a downtrend, right? When you see them in a downtrend, they represent reversal. Do you understand? So when you see them in a downtrend, they represent reversal. So that's basically all you need to know about falling wedge. So the next one we're going to be discussing is a rising wedge. And when you see rising wedge in a downtrend, it signifies continuous pattern. So when you see rising wedge, when price is dropping, it means when price breaks out of that rising wedge, price will continue to drop 80% of the time. I told you that trading is a game of probability and you want to be choosing the most probable result all the time. So when you see rising wedge in a downtrend, it represents a continuous pattern. It means price will most likely continue to drop. But if you see rising wedge in an uptrend, it means that most likely there's going to be a reversal very, very soon. So if you see them in a downtrend, they signify continuous pattern, and if you see them in an uptrend, they signify reversal. So this will be the end of chart patterns. There are tens of chart patterns in the world, but these are the ones that we see mostly in the market. So take a break, and when you are ready, we'll see in the next video.